Good morning and welcome to the World First Weekly Report for today, Thursday the 9th of June. Well, over the last week, the equity market bears have really taken hold of risk appetites. Wall Street has finally caught up with the economic data, with economic data out over the last week being a negative to the downside for the US recovery. The economic data was poor for the states. We had figures including factory orders, non-farm payrolls and mortgage apps. They all fell within expectations. As a result of the poor data, it highlights that the US recovery is not on track, and as a result we've seen equity markets, including the S&P 500, down more than 2.5% over the week. This has really been a matter of equity markets catching up with economic data. It looks like there's going to be a prolonged period of high unemployment and high underemployment, and as a result there are concerns about companies not hitting their targets at the end of the year. Furthermore, to add to the woes of the equity markets, the Federal Reserve signalled that they would not increase or would not go into quantitative easing number 3, and that they would be happy with the level of stimulus that they injected into the economy to expire in June. Bernanke, the Fed chairman, noted that the recovery is frustratingly slow. However, he also noted that their approach to monetary policy was on target. With his dovish comments and the lack of stimulus for further monetary stimulus, equity markets came off, and that dragged the Aussie US dollar cross lower with it. Locally, the economic data has really been a bit of a mixed bag. We've had economic data that has included performance of services index and job ads. They were both down. The RBA decided to keep the interest rates on hold this week. The cash rate was maintained at 4.75%, and the associated commentary released by Governor Stevens was relatively dovish. He noted that the terms of trade were at record levels. However, he also noted that there was an increase in savings and therefore less pressure on inflation and less pressure on him to increase interest rates. There was some economic data out of Australia over the last week which may force his hand in the next couple of months, may see a rate hike around August, and that was the fact that we saw a strong retail sales figure and a strong home loans figure. And as a result, like I say, we may see the Aussie propped up to $1.07 plus should we see that pressure emerge in the next couple of months. Because inflationary pressures haven't been as acute over the last couple of weeks, we've seen the Aussie pound and the Aussie euro sell off. However, we've seen the Aussie US get maintained around the $1.06 plus levels. If you'd like an update on the market or if you'd like to book a trade, don't hesitate to get in touch. Enjoy your day.